14 of 21 series are aligned with stagflation mild this morning. That is moderate agreement across the framework, with growth decelerating and inflation accelerating at the same time. The current macro regime is stagflation mild, with a confirmation score of 14 out of 21. The current macro regime is stagflation mild. Growth momentum is decelerating at UNSART minus 0.21 and inflation momentum is accelerating at MARN plus 0.01. The coherence score is 14 of 21, and the confirmation score is 14 out of 21, which places the regime in a moderate alignment band rather than a fully unified one. By our framework's historical read, comparable conditions held in about 41% of cases over a 3-month window. Compared with last week, the growth side firmed a bit inside the model while inflation momentum stayed positive, so the regime remains intact but not deeply entrenched. Across markets, this kind of setup has historically shown more uneven index progress, with defensives, gold, and cash-like behavior carrying more of the load while broad cyclicals and duration-sensitive areas absorbed more friction. That is a record of past behavior, not a forecast. The 10-year Treasury yield is at 4.58%, which the framework reads as red momentum because it is above the 4.45% threshold used in the conditional map. In our framework's reading of comparable periods, this roughly coincided with inflation pressure staying embedded within the following 1 to 3 weeks, an observation under our methodology, not a forecast. The question the data raises is simple. Does this yield level keep the market focused on discount rate pressure, or does a turn lower change the tone of the tape? Non-farm payrolls, the monthly count of added jobs, are in red momentum because the labor series has weakened in the latest read. In our framework's reading of comparable periods, this roughly coincided with softer regime confirmation across the next several weeks, an observation under our methodology, not a forecast. What challenges that read is a reacceleration in hiring or a broader improvement in labor breadth. High-yield credit spreads remain in green momentum because they are still comparatively contained, which tells market participants that funding stress is not the dominant message in the current tape. In our framework's reading of comparable periods, this roughly coincided with relatively stable cross-asset risk tone over the next few weeks, an observation under our methodology, not a forecast. What challenges that read is a sudden widening in spreads or a break in the calmer pattern around credit. The US dollar index is in green momentum because it is modestly firmer rather than in an acute trend shock. In our framework's reading of comparable periods, this roughly coincided with mixed but orderly commodity and equity behavior over the subsequent sessions, an observation under our methodology, not a forecast. What would challenge that read is a sharper dollar surge that tightens financial conditions more visibly. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, inflation acceleration appeared in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. In this regime, that would reinforce the inflation side of the current math and keep the environment centered on rate sensitivity. If fear and greed drops below 15 and holds for 5 consecutive sessions, in our framework's reading, confirmation deteriorated in roughly 7 of 9 comparable conditions, a historical characterization, not a forecast. That would matter here because the current regime already sits in a moderate confirmation band rather than a high conviction band. The map is live. These conditions are being monitored daily across all 21 series.